So, picture this. A woman is sitting on the floor of her Harlem apartment, and she's just staring at these neon pink and neon green eviction notices scattered all over the floorboards.
Oh, wow. That's heavy.
Right. It is the ultimate image of hitting rock bottom. But the cognitive dissonance here is just wild because just prior to this moment, this exact same woman was walking the trading floors at JP Morgan Chase.
That is an incredibly jarring contrast. I mean, on one side of the glass, she essentially possesses the literal keys to the financial kingdom, right?
Yeah.
She's handling sums of money that, frankly, most people cannot even conceptualize. And then on the other side, she is literally locked out of her own home.
Yeah, it's crazy. So that woman is Ashley Marie Fox, the CEO of the financial education tech company Empify. And today we are pulling from a masterclass transcript of hers titled The Wealth Blueprint, Master Stocks, ETFs, and Passive Income.
That's a phenomenal source.
It really is. And the mission for this deep dive is, it's ambitious but entirely doable. We are going to demystify the actual hidden mechanics of the stock market. Love that.
We're going to prove that you do not need a Wall Street pedigree or like a massive inheritance just to build wealth. And most importantly, we want to lay out a clear, actionable roadmap for you to generate passive income.
Which is what everyone wants, right?
Exactly.
Yeah.
Okay, let's unpack this. Because to understand the actual mechanics of how to invest, we actually have to start with the psychology of why you might be holding yourself back.
Yeah, because those mental roadblocks are almost always the initial barrier. And Ashley's origin story, it serves as the perfect lens for this.
For sure.
So she graduates from Howard University. She lands this absolute dream job at JP Morgan. And she finds herself as a rare Black woman in a space that is entirely dedicated to making the ultra-wealthy even wealthier.
Right. And she was dealing with clients who needed, what, a $25 million minimum just to talk to her?
Exactly, $25 million minimum. And while she's executing these massive trades, she looks around and realizes that 99% of people, hardworking parents, teachers, nurses, they are completely shut out of this basic wealth building knowledge. So she makes this radical choice. In 2013, she just walks away from the trading floor to teach financial literacy.
Which is incredibly brave.
It is, but removing that corporate safety net had some immediate, brutal consequences for her. I mean, she racks up $80,000 in debt.
Wow.
She faces that eviction in Harlem we talked about. She literally spends 2 years sleeping on her parents' couch back in Philly. She even had to liquidate her own $30,000 stock portfolio just to fund her new company, Empify.
Which, by the way, Empify is a fusion of the words empower and modify, which I think is a great detail.
Oh, I like that. But yeah, going through that specific crucible, it really forged her core philosophy.
It did. And it's a harsh but liberating truth.
Yeah.
You cannot save your way to wealth.
Yeah.
You just can't. And you cannot simply work your way to wealth by logging more hours. You absolutely must invest your way there.
Wait, hold on. I need to push back on something here. Just representing the skeptical listener for a second.
Sure, go for it.
So she starts investing and building this company while drowning in $80,000 of debt. Any standard traditional financial advisor would absolutely scream at you to pay off your 20% interest credit cards before you even think about chasing an 8% market return.
Oh, they would lose their minds.
Right. So how does she mathematically justify investing while carrying that kind of debt?
See, that is the exact friction point that keeps people completely paralyzed.
Mm.
Pure spreadsheet math would tell you, yeah, clear the debt first. But human beings are not spreadsheets.
Fair point.
We operate on behavioral finance and psychological momentum. Think about it. If you spend 5 years aggressively paying down debt without investing a single dime, you build resentment.
You feel like you're just treading water.
Exactly. You feel impoverished, and worse, you miss out on 5 years of market momentum and compounding interest. So Ashley's approach destroys the myth that you have to choose between fixing your past mistakes and building your future.
So it's essentially a parallel process.
It has to be. She mentions using a platform called Dovely to actively repair her credit, eventually hitting an 804 score, actually. But she emphasizes a this and the that abundance mindset.
This and that. I like that phrasing.
Yeah, you pay down the debt A and D you invest, even if it's literally just $20 a month, just to build the habit and the identity of an investor.
Which makes me think about the alternative, honestly. Is keeping all your money in a traditional savings account essentially just accepting a 0% return?
Pretty much.
While inflation acts as this slow, invisible leak in the tire of your purchasing power.
If we connect this to the bigger picture, a savings account is strictly for the preservation of cash for emergencies. It is not designed for the multiplication of wealth.
Right.
The first necessary step to participating in the economic system that runs the country is removing emotion. And it doesn't matter if that emotion is the paralyzing fear of losing money or maybe anger directed at a system that feels rigged for the wealthy.
Which is a totally valid feeling, by the way.
Absolutely valid, but emotion keeps you on the sidelines. The market does not care about your feelings. It is just a mechanism for capital allocation. If you want a different result, you must follow the blueprint, the wealthy use.
Okay, so let's assume I adopt this abundance mindset. I stop being angry at the system and I stop ignoring the math. But mindset doesn't buy groceries.
No, it does not.
If I'm a listener right now, where do I actually put my first $50 so it doesn't get, I don't know, locked away if my car transmission blows up next week? We need to transition from the theory of investing to the actual physical infrastructure.
Okay, let's get into it. That brings us to the three fundamental buckets of money. Regardless of whether you have $50 or $50 million, capital goes into one of three places. Tax now, tax later, and tax never.
Okay, let's break those down. Bucket 1, tax now. This includes individual brokerage accounts or certificates of deposit.
CDs.
The hallmark here seems to be supreme flexibility. There are no limits on what you can deposit, and crucially, you can withdraw the money whenever you want.
Which is the exact bucket Ashley utilized when she hit rock bottom. Because she hadn't locked all her money in retirement accounts, she could actually liquidate that portfolio to survive and fund her business without facing government penalties.
Makes total sense. Then we have bucket 2, tax later. These are your standard retirement vehicles, I'm assuming.
Exactly. The 401k from a corporate job, a 403b if you're at a nonprofit, or traditional IRAs.
And the defining mechanism here is deferment. Like, the IRS allows you to invest that money before they take a cut of your paycheck, which obviously lowers your taxable income today.
That's the hook. But the catch is the penalty lock. If you touch that money before age 59 and a half, the IRS hits you with severe financial penalties.
Yeah, that's the scary part for a lot of people. And finally, bucket 3, tax never.
The Holy Grail.
The Holy Grail. Roth IRAs or certain specialized life insurance policies. The money you put in has already been taxed, meaning all the growth over the next 20 or 30 years is completely tax-free.
It's beautiful.
It is. But the source material notes the IRS heavily limits how much cash you're allowed to put in every year. Why did they care? I mean, if I want to put $1 million into a Roth IRA, why would the government stop me?
Well, because tax-free compounding is arguably the most powerful wealth-building mechanism in the financial universe.
Okay.
Think about it. If a billionaire could dump unlimited funds into a Roth IRA, let it triple in value over 20 years, and then pull it all out without paying a single cent in capital gains tax, the federal government would lose out on billions in revenue.
Oh, wow. Yeah, they're not going to let that happen.
Never. The strict contribution limits are designed to keep the Roth IRA as a wealth-building tool for the working and middle class, rather than an infinite tax shelter for the ultra-rich.
That makes total sense. So for a beginner who needs flexibility and wants to avoid those early withdrawal penalties, bucket 1, the individual brokerage account, that's the ultimate starting point.
100%.
Ashley specifically mentions top platforms like Charles Schwab, Fidelity, Vanguard, and E-Trade, or I guess for those listening outside the U.S., platforms like Interactive Brokers.
Yep, all great options.
Well, let me pause here. If I'm a listener who has literally never done this, downloading a financial app feels terrifying.
It really does.
It feels like I might accidentally press a wrong button, buy 1 million barrels of crude oil, and lose my life savings. How idiot-proof is this infrastructure?
I love that question. Look, the financial services industry has historically benefited from making the access point seem like a velvet rope to VIP club.
Right, they want it to look hard.
They want you to think it's complicated, so you just pay them a fee to manage it for you. But a modern brokerage account is simply a digital bridge. It's literally an app you download in 5 minutes, and the interface is designed to be as familiar and straightforward as, like, an online shopping cart.
Okay, that's definitely reassuring. What about for kids, though? Ashley brought up something incredibly powerful called a custodial account, specifically the UGMA or UTMA. What do those letters even mean, and how does that mechanism actually work?
Okay, so UGMA stands for Uniform Gifts to Minors Act, and UTMA is the Uniform Transfers to Minors Act.
Okay.
Basically, it is a legal mechanism that allows an adult to open and manage a brokerage account on behalf of a child. But the brilliant part is that the assets legally belong to the minor.
Oh, interesting.
Yeah, and because the child's in a much lower tax bracket, usually a 0% tax bracket, The investments can grow and generate dividends with massive tax advantages.
Wow, she used the example of her 9-year-old niece, Journey. Ashley started an account for her the day she was born with just $35.
$35.
And through consistent small contributions over 9 years, Journey now has nearly $10,000 in passive income from a $35 seed.
It's incredible.
It completely changes the trajectory of a child's financial life before they even enter high school.
It is the ultimate proof of compounding interest over time. Starting early is everything.
All right, so let's say I have the app on my phone. I have the digital bridge. I transfer $50 in. Now what?
Right, because an empty account doesn't do anything.
Exactly. An empty account doesn't generate wealth. We have to move from the account itself to the raw assets. Now, the source material uses this classic metaphor comparing a company to a pizza and a stock to a single slice.
Yeah, the pizza analogy.
It's okay for explaining what a stock is, but I think we need to upgrade the analogy to understand how it actually makes you money.
I agree. Let's reframe it. Instead of a slice of pizza, imagine you are buying a single table in a highly successful, bustling restaurant in your city.
Okay, I'm picturing it.
You do not manage the waiters, you do not cook the food, you don't even sweep the floors. But because you hold the deed to that specific table, at the end of the night, you are legally entitled to a percentage of whatever profit that table generated. You're acquiring an income-producing asset.
Okay, that clicks for me. But I'm guessing not all tables act the same way. We essentially have two primary types of stocks to choose from here: growth stocks and dividend stocks. Let's start with growth.
Sure. So if you own a table in a growth-focused restaurant, think of massive tech companies like Amazon, Netflix, or SpaceX. They take every single dollar of profit that your table earned that night, and instead of giving it to you, they use it to build 5 more tables.
Or open a new location across town.
Exactly. They plow the cash back into the business to aggressively conquer the market.
Which honestly sounds terrible on the surface. Like, why would I want to own a table that never pays me a dime at the end of the night?
Because by reinvesting all that cash, the company becomes significantly larger and more dominant. In 10 years, the intrinsic value of that single table you bought might have grown by 700%.
Ah, okay.
You make your money when you eventually sell the table to someone else for vastly more than you paid for it. It is entirely about capital appreciation.
Got it. Then we have the second type, dividend stocks. Ashley calls these the mature dinosaurs of the market.
The dinosaurs, yeah.
They are incredibly established and profitable, but they aren't growing at breakneck speeds anymore. They aren't, building new restaurants every week. So what do they do with the profit your table generates?
They share it directly with you.
Exactly, as a cash deposit right into your account, which is called a dividend. She points out the dividend yield percentage. For example, AT&T offering roughly a 5% yield, meaning they pay out actual cash to you every 90 days just for holding the asset.
It highlights the fundamental difference between investing for capital appreciation versus investing for cash flow.
And Ashley uses a fantastic pop culture analogy here. She says growth stocks are like LeBron James right out of the draft.
I love this analogy.
It's so good. Explosive, aggressive, trying to take over the world and prove everything. And then dividend stocks are like Jay-Z today.
Yeah.
He is seasoned. He's reliable. He isn't putting out a brand new, highly anticipated album every single year. But his massive catalog and his existing businesses are constantly, quietly generating cash.
So true.
But wait, let me challenge this. Isn't investing in a rookie LeBron incredibly risky? Like, what if he blows out his knee in the first season? What if that growth company tries to conquer the world and just goes bankrupt?
That is a phenomenal point, and it's the exact reason you should never go all in on one strategy.
Okay.
Growth stocks carry significantly more volatility. A newer company can absolutely fail, taking your investment straight down to zero. That is why a truly resilient, intelligent investor doesn't choose between LeBron and Jay-Z.
You want both.
You need both in the room.
Yeah.
You utilize growth stocks as the engine for long-term wealth multiplication, right, to beat inflation over decades. But you utilize dividend stocks for immediate, reliable cash flow to stabilize your portfolio during rough economic weather.
But let's look at the practical reality of doing this. What if buying an individual table in a trillion-dollar restaurant is just, I don't know, way too expensive?
It often is.
Buying a single share of an Nvidia or a Meta could cost hundreds of dollars. If I am a beginner with my very first $60, I am completely priced out of diversifying my risk.
And this brings us to the concept of bundling. which is arguably the most important equalizer ever created for everyday investors.
ETFs, exchange-traded funds. Instead of buying one single table in one specific restaurant, an ETF lets me buy a microscopic fraction of a table in 500 different restaurants all at once for one low price.
Exactly. And we must draw a hard line here between ETFs and the older traditional model, which are mutual funds.
What's the main difference?
Well, historically, if you wanted a bundled basket of stocks, you bought a mutual fund. But mutual funds often require steep minimum investments. I mean, sometimes $2,500 just to open the door.
Wow, yeah, that's a barrier.
Right. And worse, they are actively managed by teams of highly paid Wall Street analysts. Those analysts, they take their salaries out of your returns in the form of high fees.
Yikes.
But ETFs, conversely, trade instantly on the open market just like a regular stock. You can buy one share for $60. And because they are passively managed, meaning they simply run on an algorithm that tracks a specific sector or index, they have incredibly low expense ratios.
Right, Ashley mentions aiming for an expense ratio under 0.75%, or ideally finding ones around 0.045%. But break that math down for me. Why should a listener obsess over a fraction of a single percent? It sounds like we are arguing over pennies.
It is pennies in year one. But stretch that timeline out. Imagine you invest over 30 years. An expense ratio of 2% on a mutual fund versus 0.04% on an ETF doesn't just cost you the initial fee.
What does it do?
It robs you of the compounding interest that money would have generated over 3 decades. High fees act like a parasite on your portfolio. They are capable of devouring tens or even hundreds of thousands of dollars of your potential future wealth.
Oh my God.
Yeah, keeping that expense ratio near zero ensures the miracle of compounding works for you, not the fund manager.
Wow. That puts it into a terrifyingly clear perspective. And the examples of these low-cost ETFs she gives are mind-blowing.
Let's hear them.
For around $60 a share, you can buy the Fidelity Blue Chip Growth ETF, which instantly gives you a basket holding heavy hitters like Meta, Apple, and NVIDIA.
Great growth engine.
Or, if you believe artificial intelligence is the future, there's an ETF called AIQ, trading around $64 a share, that bundles dozens of companies actively profiting from AI.
Right.
And if you want that Jay-Z money, the reliable cash flow, the Schwab U.S. Dividend Equity ETF trades around $30 a share and bundles cash-flowing giants like Coca-Cola and Chevron.
I love how accessible that is.
And anyone can research the exact contents of these baskets by pulling up their fact sheets on databases like etfdb.com.
It completely lowers the barrier to entry, offering institutional-level diversification without needing institutional-level capital.
And then the source material introduces a concept that feels like an absolute cheat code for real estate.
Oh, this is my favorite part.
So many people want to invest in property, right? But they don't have a $50,000 down payment, and they definitely don't have the patience to deal with fixing a broken toilet at 2 in the morning. The solution: REITs. Real estate investment trusts.
Yes. A REIT is a massive company that owns, operates, or finances income-producing commercial real estate. You buy a share of a REIT on your phone exactly the same way you buy a share of a stock or an ETF.
But the golden rule of REITs, the reason they are so incredibly powerful for an investor, is a legal mandate. By law, REITs are required to pay out a minimum of 90% of their taxable profits directly to their shareholders in the form of dividends.
90%.
Why would a company ever willingly surrender 90% of its profit?
Because in exchange for doing so, the IRS allows them to avoid paying corporate income tax entirely.
Oh, wow. That is a massive loophole.
It is. They essentially pass the tax burden and the massive continuous cash flow directly through the corporation and into your pocket.
And we are not talking about obscure, rundown buildings here. We are talking about the physical infrastructure of the modern economy. VC properties. They own the actual real estate for iconic Vegas casinos like the Bellagio, the MGM Grand, and Mandalay Bay.
That's huge.
Every time someone drops a coin in a slot machine or pays for a hotel room, a fraction of that rent flows back to the REIT. EPR Properties owns Topgolf locations. Prologis owns the massive, sprawling warehouses that Amazon relies on to ship our packages.
They're everywhere.
And Realty Income. They own the physical buildings for everyday staples like Walgreens and 7-Eleven. In fact, Realty Income has paid a dividend to its investors every single month for 25 consecutive years.
What's fascinating here is how REITs and ETFs entirely reframe your physical environment. They take your routine daily consumption habits and turn them into a personalized roadmap for your investment portfolio.
Here's where it gets really interesting. Think about a normal day in your life. You hit snooze on an Apple iPhone. You brush your teeth with Crest toothpaste. You stop and buy gas at Chevron.
Yep, happening right now to millions of people.
You check Instagram, which is Meta, and you come home to an Amazon package sitting on your porch. You have just paid 5 different corporations before noon. We cheerfully hand our hard-earned cash over to these companies every single day, accepting a 0% financial return.
Zero.
Why are we so incredibly comfortable being 100% consumers? But the moment someone suggests we open a brokerage app and own a piece of the companies we literally cannot live without, we are paralyzed by the risk.
It is a profound, almost tragic psychological block. I mean, we trust these massive corporations to deliver our goods, secure our private data, entertain our families, yet we do not trust them enough to participate in the astronomical profits we are actively helping them generate.
It's wild when you put it like that.
Overcoming that block is simply a matter of shifting your identity from a spender to an owner. And Ashley highlights the story of her 80-year-old student, Sarah, to prove this exact point.
Yes, I loved this part. Sarah had absolutely no background in finance. She spent her whole life working hard, but she was just tired of being on the outside looking in.
Never too late.
At 80 years old, she opened her first brokerage account, bought into REITs, and started collecting passive dividend income. She pivoted from purely spending to actively owning.
It is absolute proof that the barrier to entry isn't your age, your background, or the amount of time you have left. The only true barrier is the decision to finally step onto the playing field.
It fundamentally changes how you view everything around you. And that really brings us to the core synthesis of this entire deep dive. Investing is not some velvet-roped VIP club reserved for Wall Street insiders with legacy wealth.
Not at all.
The infrastructure to build generational wealth is sitting on your phone right now. By opening a simple, free, individual brokerage account, understanding the crucial difference between growth for the future and dividends for today, and utilizing tools like ETFs and REITs to buy the entire basket instead of risking it all on one slice, anyone can build a customized engine for passive income.
Anyone.
And you can start the engine with just $20.
The mechanics of the market are surprisingly straightforward once the jargon is stripped away. It is simply about consistency and execution over time.
Which leads perfectly to a final provocative thought I want to leave you with. Tomorrow morning, when you wake up and go through your exact normal routine, when you pick up your phone, when you squeeze the toothpaste onto your brush, when you buy your coffee or drop off a package, take a mental inventory.
I love this exercise.
Look closely at the logos on the products you trust your life with. How many of those companies, the ones cheerfully taking your money today, could actually be paying you a dividend by next quarter? Because you can spend your whole life staring down at the eviction notices on the floor, or you can look up, download an app, and own a piece at the Bellagio. The choice is entirely yours.